Thank you very much. Got more claps for my introduction than I did for my joke, so I might keep my jokes to a minimum. Okay, so the CBA is one of the leading banks in Australia, serving more than 17 million customers. And with this, I am in the fortunate position of having access to a multitude of information and subject matter experts. I'm not just talking about everyday banking, I'm referring to the tools, resources and data analytics that can assist local governments in future-proofing their financial future. If you're interested in learning about carbon markets, economic development, data analytics, the Employee Benefits Program, or would like to hear one of my jokes, please do visit myself or James at booth 26 over the next 2 days. We'll be more than happy to have a chat, and we can always check your balance if you're desperate. Given what's happening in the world right now, I think it very timely to introduce you to the man with the most interesting role in the bank. As a senior economist, Stephen Wu is involved in analysing economic trends in Australia, as well as communicating views on the economy and the implications for monetary policy. Prior to joining the Commonwealth Bank, Stephen was an economist at the Reserve Bank of Australia, working in the Economic Analytics Department. He has 6 years of experience as an economist, covering the Australian global economics. He holds a Bachelor of Commerce in Economics Honours and, keeps going on, and Finance, as well as a Bachelor of Arts degree with the University of Sydney. I don't know about you, but with that background, I'll be listening very intently to Stephen's update, which I have personally coined, Stephen, what is the world coming to? So please do join me in welcoming Stephen Wu to the stage.
Thanks, Tanya. So look, I don't have a short answer to what's going on in the world right now, but hopefully over the next 40 or so minutes, I will be able to kind of explain some of the risks that we are looking quite closely as we go through the rest of 2025 and into 2026 as well. Tanya did say that I have the most interesting job at the bank, but really that just means I'm constantly glued to Twitter, looking at Donald Trump's tweets and figuring out what that all means for Australia. So it has meant that the work has certainly increased, just trying to keep up with all the announcements and the backtracking coming out from the US. So there is a lot going on. As I said, globally, lots happening there, but also domestically too, where just a week away from the federal budget being announced next Tuesday, just around the corner as well from the RBA's next meeting, which is scheduled for 1 April. And also as well, we're going to be hearing some more news around tariffs from April 2nd. So it is a lot going on, but hopefully in the next 40 minutes or so, I can distill to you what's really key and what's really going to be driving outcomes here in Australia. So this slide here gives you a brief summary of our view on the Australian economy. Look, we went through 2024 going through a bit of a soft patch. We saw very weak GDP growth. We saw high inflation, but things are looking more on the upside now domestically. So we are thinking that we have passed the worst of growth of the weakness in growth in the economy, and we are going to see an increase in activity driven in particular by the household sector. That's going to be driven by the impact from the stage 3 income tax cuts, from further expected interest rate cuts, helping to support the mood and sentiment for consumers and therefore pushing up spending as well. We are pretty optimistic on inflation. We think inflation will settle back within the RBA's inflation target all through this year. And that does mean that the RBA doesn't have to be so cautious about high inflation, and they can be more actively concerned and reactive to the downside risk to the global growth picture. That being said, unemployment is still expected to rise a little bit over this year. It is a lagging indicator, so the previous weakness that we saw in the economy should, over time, translate across to a slightly higher unemployment rate, but ultimately still going to be well below where it was before the pandemic. Now, as I said, there are a lot of risks to this central scenario where we do see a pretty optimistic picture for the economy. There is a lot of downside risk coming through from what's happening with the US and the tariff policies from Donald Trump, and also that does eventually flow through and impact Australia. So we are watching this very closely. And also domestically, we do have a federal election coming up soon, so that can also have an influence on how the economy will evolve over this year and next year as well. So that was a bit of a long summary, but kind of giving you a flavour of what to expect over the rest of this presentation. But firstly, just to start off by highlighting that growth in the economy has been exceptionally weak. We did see a bit of a pickup over the last quarter of 2024. So growth over the year to December quarter rose by 1.3%, a little bit higher than what it was earlier on last year, but still very, very weak. But there are some green shoots emerging now. That is a reflection of the impact from restrictive monetary policy, which by design has slowed growth in the economy. Now, these green shoots are welcome news, but if you look into the details a little bit more, you will see actually that the pickup has been really focused primarily on the public side. So if you look at just the private sector economy, which are those blue bars on this chart here, it's still going through a soft patch right now. So the latest uptick in growth has been a reflection of an increase in government spending, supporting growth outcomes overall. Now, in terms of the weakness in the private sector, that really has been focused on the household sector. So consumer spending has been exceptionally weak. If you look at comparison between Australia and in the US, which is the chart on the left there, you can really see the difference. So in Australia, households have seen 24 months, so 2 whole years of quarterly contractions in per capita spending. So people are spending less each quarter over the last 2 years. And that's a very different picture to in the US, where spending growth has still been very solid so far. Now, this weakness in spending has been focused on discretionary consumption, which has slowed the most. That's, I guess, quite an obvious observation. It's a lot easier to cut back your spending on things like recreation, clothing, and the like. A lot harder to reduce spending on school fees, insurance, and that sort of stuff. So that has been where we've seen the weakness come through from the consumer. Now, we do think that this year will be a bit of a better picture for consumption outcomes, and that's going to be driven by the improvement in real household disposable income, which is what this chart here shows. So the black line shows you that we did see a period of declines in disposable income over 2023 and parts of 2024. Obviously, that was driven by the big increase in interest rates, adding to mortgage repayments. Also, as well, we did see bracket creep, having a weighing impact on incomes. And finally, inflation was too high. That sapped the purchasing power of households. All 3 of these factors are getting smaller in terms of its impact weighing on disposable income. So we do expect this rebound in disposable income to support growth outcomes over this year. Now, this chart here shows you our internal CBA spending and income data. So at CBA, we're very lucky. We are obviously Australia's largest financial institution. So we see roughly, 1/3 of all transactions in the economy, and we can see at an anonymized level, spending on CBA credit and debit cards, and also incomes being paid into CBA bank accounts. And what we can see here in this chart on the right, a couple of things. We did see the pickup in after-tax incomes, given the stage 3 tax cuts flowing through that help support income growth. But we haven't really seen as yet an equivalent rebound in household consumption. There are some signs that this is recovering, but it has been a very modest increase relative to the scale of where income growth has been after those stage 3 tax cuts. And this is data up to and including just last Friday, so essentially a real-time read on the economy. Now, why we have seen this really modest increase in consumption outcomes is really a reflection of a very pessimistic and very cautious consumer. So this chart here shows you there's really been very weak sentiment across roughly 2/3 of all households. So those that rent and those that own a mortgage, which is roughly 2/3 of households, they are still very pessimistic right now. In contrast, the Australians that own their homes outright, which is that green line there, they have seen a stronger rebound in sentiment because inflation has come down, and obviously they have been relatively unaffected by the big increase in interest rates that's been delivered over the last few years. So this is weighing on sentiment and weighing on consumption outcomes, but we do expect this to fade over this year. Now, given this very pessimistic sentiment, we have seen a strong focus for consumers in saving any of the additional money coming from the tax cuts. So obviously there's been a big increase in mortgage repayments as interest rates have increased. But as a chart on the right there shows you those green bars there's been a really strong inflow into what we call excess payments. So that's money into your offset and redraw balances. And this is a reflection of consumers understanding that the opportunity cost of not paying down your mortgage debt is very high. So households are prioritizing paying down their mortgage debt a little bit earlier to avoid or minimize the interest rate costs from their mortgages. So this sort of mindset is still very much prevalent thus far, but we do expect, as I said, as things improve a little bit over this year, to then see a shift in sentiment and consumption growth start to modestly recover through this year. But ultimately, though, we know Australian households are amongst the most highly indebted in the world. As this chart here shows you, household debt as a share of income is exceptionally high. It's significantly higher than what it is in, say, the UK and in the US, where they went through a bit of a deleveraging cycle after the global financial crisis. Not the case here in Australia, so household debt is still very elevated, and what that does mean is households here are much more sensitive to interest rate movements than many other economies. The other factor to consider too is that in Australia, the majority of housing debt is at variable rates. And what that means is when the RBA lifts the cash rate, all borrowers, not just new borrowers, experience an increase in their repayments. What that has meant is, even though the RBA increased the cash rate by less than in many other economies, the actual impact on the average mortgage rate was significantly higher here than anywhere else, really. So we've seen a roughly 350 basis point increase in the average mortgage rate being paid by households, which is very different to, say, in the United States, where because the most common mortgage is a 30-year fixed rate mortgage, the average borrower in the US has been largely insulated from any rate hikes that's been delivered by the Federal Reserve. So it's a very different picture and helps to explain why consumption has been so weak in Australia, but still reasonably strong in the United States. Now, turning to inflation, we've really had a good run of inflation data over the past 6 months or so. So over the past 6 months, inflation on an underlying or core basis has been at 2.7%, so back within the RBA's inflation target. And that has spurred the RBA to revise down their forecast for inflation over the next couple of years. And that really has allowed the RBA to go from saying they don't expect to cut rates anytime soon to delivering their first rate cut last month. And that was really because of softer than expected inflation outcomes and a faster return to the inflation target than previously anticipated. As I said, if you look at the last 6 months, inflation is very clearly back within the RBA's inflation target. The annual rate, so over the full year of 2024, the underlying rate is at 3.2%, but over the last 6 months, it's only at 2.7%. So we are seeing a faster slowing in inflation pressures, and we expect, when we get the March quarter numbers in April, to see this ongoing disinflation pulse come through. Now, this isn't just a function of one or two items where we've seen inflation come down. It has been very broadly based across the entire CPI basket. So this chart on the right here shows you that the share of items in the CPI basket where inflation is growing above 3%, in other words, above the RBA's inflation target, has dropped significantly from around 80% down to about 40%. And vice versa, we've seen as well the number of items where inflation is actually below the 2% lower bound of the inflation target actually increasing as well. So it is broadly based, not just focused on one or two items. That gives us a bit of confidence that inflation will come down and remain within the inflation target over this year. The other good news as well on inflation is that housing-related inflation has slowed substantially. So new dwelling construction costs have come down significantly in terms of the rate of growth, and also advertised rents growth has also slowed. Now, to be clear, these costs are still rising, but they are just rising at a slower pace, which is going to be good news for those that are renting and also those that are looking to buy a new home as well. Now, there are some differences between the capital cities, and in particular, there is still some additional pressure here in Perth relative to the other capital cities. So both new dwelling construction costs and advertised rents growth are a little bit stronger here in Perth than other capital cities, and that is a reflection of a still very tight rental market and also ongoing issues with adding to supply of housing here WA. So there is still some pressure here in Perth, but across the East Coast at least, those pressures have moderated a lot more. Now, that was just for data for 2024. If we look at some more timely indicators that cover January and February this year, we are still seeing very encouraging signs that disinflation continued. So we are seeing final prices growth and output prices growth for businesses are slowing, and that is seeing inflation, we think, continuing its downward trend. What we have noticed, though, is that input costs, so purchase costs for businesses, have actually still been a little bit more elevated. So that is reflecting, I think, there's still some issues around shipping of goods and services of goods around the globe, and that means that we are still seeing elevated input costs, but the ability for businesses to pass these costs on to consumers is increasingly limited. And that's because of weak demand from households, limiting the amount in which businesses can pass through these higher cost pressures. So that does mean that businesses' margins are being compressed a little bit. And we are seeing this through in other parts of business surveys. So business conditions and business profitability have been sliding for some time now, and they're both below their long-term averages. Importantly too, it's really the smaller businesses and the small and medium enterprise enterprises that are seeing a bit more of an impact. So their reported conditions are quite a bit weaker than the aggregate for businesses overall. So we are seeing it's the smaller sort of end of businesses that are facing increasing pressures and lower profitability and lower margins. So that's something to watch there. Now, what has been a surprise for pretty much all economists, us included, has been how resilient the labour market has been. So we've seen over 2024 essentially a flat unemployment rate at about 4%. That hasn't really shifted much, even though we've had very weak growth outcomes. And in a very good piece of news, we have seen the share of the population that's currently employed at record high levels. So there are more Australians relative to population that are currently employed than ever before, which is good news for the economy. But this has been a surprise given the very weak growth outcomes. If you look at this chart here, over the history of the series, we have seen typically growth outcomes and employment outcomes go hand in hand, as you'd expect. But recently, that has diverged. So we've seen weak output or weak growth in GDP, but we've seen an unusual situation where employment growth has continued to actually increase. So this gap here is extremely unusual. Now, what we think is going on is really a reflection of a shift in where we are seeing growth coming through in terms of jobs. In particular, if we split out jobs growth by the market sector and the non-market sector, we actually find that the vast majority of jobs growth has been through the non-market sector. That's defined as healthcare, education and training, and public administration. So these three sectors, in particular healthcare, has driven the lion's share of jobs growth in the economy. Now, the healthcare industry, the growth in those jobs there is a reflection of prioritization of spending in the healthcare sector. We obviously have an aging population that necessitates more investment, more jobs within the healthcare sector, but also as well, the growth in the NDIS has also supported job outcomes there too. So that has meant that those sectors are growing really quickly in terms of jobs and supporting overall outcomes in the labour market. But if you look at just the market sector, which is more attuned to the business cycle, that has been quite weak for some time now. So that's where we are seeing a bit of a bifurcation of outcomes across the labour market. But looking ahead, we still do expect to see unemployment lift further from its very low levels. If you look at indicators like job ads, they're coming down significantly from their peaks in around mid to late 2022. You look at the number of applicants, these job ads, they're also increasing as well, pardon me. So we are seeing more supply of labour and slower demand for labour. And the difficulty in recruitment, as reported by businesses, has gotten easier. So that means that there's just easier to find labour, and that means as well that puts downward pressure on wages growth as we work through this calendar year. Now, even though we did see unemployment track sideways for all of 2024, we did still see wages growth come down. That's been true across all the different wage setting mechanisms. So whether you're paid via an award, an enterprise agreement, or individual arrangement, we did see wages growth come down over last year and 2023 as well. Now, in Australia, the wage setting mechanisms are a little bit lagged. So for instance, if you're paid via an enterprise agreement, typically these are negotiated over multiple years and then locks in wages growth over a number of years. So, we don't expect to see much more weakening in wages growth, but we're just going to settle at around that 3% mark, which will be consistent with inflation back to target, we think. But I think from the wages side, it's important to focus on wages growth in the private sector and also wages growth for those on individual arrangements, because those are the most attuned to the business cycle, and we are already seeing very clear signs that they have been coming down. So the chart on the right there shows you quarterly wages growth in the private sector. Aside from a couple of spikes related to the increase in the minimum and the award wage, we have seen a pretty steady decline in wages growth over a number of quarters now. And given that we still expect to see slowing in the labour market, that should see further weakness there in the private sector wages growth. So I've talked about wages growth coming down. I've talked about inflation returning back to the inflation target. And I've also mentioned as well that we do expect to see outcomes for the consumer sort of stage a modest recovery over this year. Now, this is all premised on further easing by the Reserve Bank. We don't think the Reserve Bank will just reduce interest rates once and then leave it there. We think further rate cuts are on the horizon for households. So to kind of put some numbers around this, we expect to see 3 more rate cuts this year, roughly 1 each quarter, to take the cash rate down to 3.35% by the 4th quarter of this year. The blue line there in this chart just shows you financial market pricing, and that's roughly in line as well with our view. So about 65 basis points or so, 2 and a bit cuts to 3 cuts priced in by financial markets as we go through this year. Now, this we think is going to be a reasonably shallow easing cycle. And we certainly don't expect to see interest rates back to where they were before COVID. If you remember, in 2019, the RBA was cutting interest rates down to 0.75% in the middle of 2019, and we don't expect to see that sort of cash rate anytime soon. And that's because there's been some structural changes in the economy and globally as well. That means we think interest rates will be higher on a sustained basis going forward than it was before the pandemic. There's an idea in economics called the neutral rate, which is the rate where the cash rate is not stimulatory or contractionary for the economy. So it means at this theoretical neutral rate, inflation is at target, wages growth is consistent with that as well, and the economy is growing at a trend rate. Now, the RBA's estimates for where this neutral rate is roughly 3%. So it has increased from where it was before the pandemic. So that means, we do expect to see the RBA normalize the cash rate down to around these neutral levels. So what that means is the RBA is simply easing off the economic brakes, but they're not really putting their foot on the accelerator. They're simply just reducing the amount of restrictiveness in policy, which is necessary unless you want to see even more slowing in the economy and a sharper rise in the unemployment rate. Now, as I mentioned at the very beginning of this presentation, there are a lot of risks around this central scenario for the domestic economy. One key one, obviously, is just around the upcoming federal election. It's not quite clear, who's going to win, and also what policies might be announced in the lead up or in the middle of the election campaign. What we do know is that there is still a lot of spending that's baked in to the budget. There's a need for increased spending on healthcare, on infrastructure, and also as well increasingly on defence, given the issues we're seeing globally. So we are watching very closely next week's federal budget to see what's going to be announced and what those numbers would look like. Obviously, bearing in mind that if we do, when we get the election as well, and depending on the outcome of that election, we could see shifts to those numbers. Importantly too, it's not just the federal government spending that we need to be looking quite closely at. How the state government also spends and taxes is going to be really important as well. There is, as I said, a lot of spending required on infrastructure and healthcare across all the different states and territories. So that is one to watch in terms of how that feeds into growth outcomes and inflation outcomes in the economy. Now, turning to home prices, this has been a very unusual cycle for home prices. Over 2023, when the RBA was hiking interest rates, we did see, unusually, an increase in home prices, and in particular led by the smaller capital cities, not least, of course, Perth, where has seen really rapid increases in home prices. So as you can see here in the chart and the table here, really strong growth in the capitals, across all the capital cities, primarily though around Perth, Adelaide and Brisbane, seeing really strong rises. We did see over the back end of last year some falls in home prices in Sydney and Melbourne, but that looks to have turned a corner already and things are rising again as the RBA has embarked on their rate cutting cycle. Now, looking ahead, what we think we're going to see is still an ongoing imbalance between housing demand and supply. We know we have seen over the last couple of years very strong growth in population that's added to demand for housing, and at the same time there has been capacity constraints in the resi construction sector, meaning that we haven't really been able to add quickly to housing stock. So this chart here shows you in the green dotted line the government's target to build 1.2 million new homes in the next 5 years. That's essentially equal to 240,000 new homes every year for the next 5 years. And you can see, based on the approvals, commencements, and completions data, we're not building anywhere close to this amount of housing. So we still expect to see a structural imbalance between demand and supply for housing, and that's going to be supportive of growth in home prices over the medium term. Now, this does differ by the different capital cities. Obviously, the ability for each state to kind of add to housing stock differs, and also as well, pressures via population growth differ as well. Now, we have noticed there's been the strongest growth in population in WA. So WA has received significant inflows of net overseas migration, like Sydney and like Melbourne as well. But what we have also noticed too is that interstate migration has also been adding from growth in WA. So WA has seen the strongest growth in population at about 3% over the past year, as people, from say Sydney or New South Wales have moved to the West Coast here in WA. So this has been adding a bit more pressure than otherwise in terms of demand for housing. Now, speaking of housing, it has also been supported by the strength in the WA economy. And you can see this very clearly in a number of different variables. So the chart on the left there shows you spending on CBA credit and debit cards. And you can see in particular that spending growth has been very strong in WA relative to the national average. Which has been a reflection, of course, of very strong sort of state fiscal position, and also because of very high commodity prices supporting the state's income via royalties. In addition, we have seen very low underutilisation rates in WA. Chart on the right there shows you it has been below the average in Australia over pretty much the last couple of years, after spending the pre-COVID period above the national average. So conditions here in Perth and WA more broadly are generally more optimistic and more positive than across most of the other parts of Australia. So there's much to be sort of optimistic for here on the West Coast. In terms of housing supply as well, we are seeing additional green shoots coming through in terms of the ability for the sector to add to supply for housing here in Perth. You can see the chart on the left there, been a very solid uptick in dwelling completions, adding to the housing stock here. And that has supported an uptick in the rental vacancy rate, which is the chart on the right there. So after spending a very long time at very low, even record low levels, we are seeing a more normalization of rental vacancy rates. And that does mean that for the renters out there, they are seeing less pressure in terms of the growth in rents so far. That being said, it's still a very tight rental market. So for a bit of context, a rental vacancy rate around 3% is considered healthy, and the numbers here suggest that we are still facing a very tight rental market, just not as tight as before. Now, I guess kind of to end by looking a bit more at the global picture. And really, there are a lot of downside risks here that we are very wary of. There's obviously the uncertainty around tariffs coming from the US and how that will impact Australia and the other US trading partners. There's also the ongoing geopolitical tensions, wars in Ukraine, tensions between Israel and Hamas. They're all ongoing and adding to uncertainty globally. But in terms of the tariffs from the US, I think the important thing to really remember is to think about, in particular, where Australia really does most of its trades with. And Australia has really pivoted to Asia, in particular China, as our trading relationships. So the chart on the far left there shows you that by far our largest trading destination or largest trading partner and export destination is China, and obviously the bulk of that is via iron ore exports coming out from WA. In contrast, the US is a much smaller trading partner for Australia, and that means that any impact or any direct impact from tariffs from the US on Australian exports is going to be a lot more modest. And what we actually are more worried about is exactly how the tariffs impact China. So if the Chinese economy slows substantially, that's going to be negative for commodity prices. It's going to be negative for government budgets, including the WA government budget. It's going to be negative for income growth here in Australia. On the flip side, if we do see Chinese policymakers act to avoid the slowdown in the economy by adding to more fiscal stimulus, that could be supportive of commodity prices, of the Australian dollar, and also of our budget bottom line as well. So it really is very highly dependent on how policymakers in China respond. That has a much more a direct impact on how outcomes here in Australia will fare than what happens in the US, so to speak. That being said, there is still a lot of uncertainty. In particular, it's expected we'll hear from Donald Trump on April 2nd when he delivers another round or announcements of another round of tariffs across all the US trading partners. We don't know what that will look like, but if they are going to be substantial, that does add to downside risks for the Australian economy. And I guess finally, around the Aussie dollar, that has seen a significant period of weakness since Trump was re-elected at the tail end of last year. We've seen a big slide in the Aussie dollar, really driven by strength in the US dollar. And we do expect to see essentially the Aussie dollar spend most of this year in the low 60-cent range, given uncertainty in the global economy, downside risks as well to growth, even though we are still expecting to see reasonably elevated commodity prices still. It will take until 2026, we think, until we see a more sustained recovery in the Aussie dollar back to more normal or fair value levels. Now, there is a lot of uncertainty, particularly in the Aussie dollar, just because of how volatile it is, and any announcements, by the US around tariffs can have a material impact on the Aussie dollar. So these screen caps here just highlight exactly how volatile it is. Any announcement by the US administration can have an immediate impact on the Aussie dollar and on a sustained level as well. As you can see here, last month in early February, a couple of announcements there saw immediate impact on the Aussie dollar. So we are obviously very acutely watching what happens there as well. So to wrap up, I might just end back on the first slide here as a recap of our view on the economy. Look, our central scenario is still to see a soft landing for the economy. And what that means is inflation back within the RBA's inflation target, only a modest increase in unemployment, and a steady, modest recovery in GDP growth in Australia. That is, I think, a pretty optimistic sort of set of numbers, and there's going to be a lot of downside risks to what happens from here on out. A lot depends on how the US administration delivers on their proposed tariffs, on how China responds to those tariffs, and also how the geopolitical uncertainty feeds through to outcomes here in Australia. So look, I think I might just leave it there, and I think we have time for some questions. There are going to be a couple of roving mics around, so if you have any questions, happy to answer them. Just pop your hand up and I think a mic will be delivered to you.
Okay, Stephen, thank you. Round of applause for Stephen, ladies and gentlemen. That's fantastic. It's quite remarkable the effect that Trump has on everything. That was the thing that came home to me. So, yes, it's an interesting time predicting what he might get up to. Do we any questions? We've got a mic down the back. Yes, my friend.
Thanks, Stephen. You're kind of like an intellectual angel. Can you explain with any credibility if there's an economist or an economic theory that supports all of this tariff business? That's question one. And then question two, where are you investing at the moment?
Just a small question, the first one.
I'll start with question two first, because it's an easy one for me. I just can't say. I can't give financial advice, is the short answer out of that. But look, I think there's a lot of uncertainty going on. And I think when you think about the tariffs, there really isn't a lot of sort of economic theory that backs the imposition of tariffs. It impedes trade flows, it's bad for growth, adds to inflation, it's all negative for the global economy. So I think it's really more to do with a shift in how the US administration wants US to be positioned in the world, and less really about sort of the economic impacts or the benefits supposedly from those tariffs. It's going to be bad for the US consumer. We've already seen as well some sort of timely data in January and early parts of February that spending by US households has essentially dropped off a cliff. There's a lot of uncertainty about how inflation will evolve, and it could mean that in the US, the Federal Reserve might not be able to cut rates any further because of the expected inflationary impact from tariffs hitting the US economy. So there is a lot of uncertainty. If you recall, when Donald Trump won the election in the tail end of last year, there was a massive rally in US equities. There was a narrative about US exceptionalism, that we're going to see US go from strength to strength. Now we've seen over the last, say, month or so, a really big recalibration of that narrative. We've seen a big fall in US equities. We've seen, big ructions in financial markets as people have come to realize actually that these tariffs will have an immediate impact on growth outcomes, on inflation outcomes, and it will take some time for this to kind of shake out both in the US and globally as well. So I think there's a lot of uncertainty there and a lot of downside risks. These sorts of numbers that I had earlier up there in terms of a soft landing for the Australian economy, that could all change very quickly if we hear more about the tariffs and if they're going to be a lot more punitive than we previously thought. So I think it's, a lot of uncertainty right now, unfortunately, but it does make our jobs very interesting.
Very interesting, all right. Who's going to be the first to use the QR code and give us a question? Come on, who's got the bravery to do that? Because we wouldn't mind getting a question up on the screen as well. Where were you investing, did you say? With CommBank, was it? Was that the Can-Do Bank? And if your fixed line's about to run out, would you stay on the fixed, or would you go variable for your home loan? Only joking, I'll talk to you personally. Any other questions from the floor, or anyone hitting the QR code there? We've got still got a little bit of time there, about a minute. If anyone wants to feel free to ask a personal question. This is quite remarkable. It is quite remarkable that if Trump does a backflip or something, you have to adjust quickly, and if he changes his mind, which he can do. And the card spending in Western Australia was a fascinating thing to see as well, given that it's quite optimistic for the future in WA, isn't it? That's what you're saying. That was your bottom line, wasn't it? That we are pretty optimistic over here. Yeah,
I think the outcomes here in WA are looking a lot more optimistic and positive than in many other parts of Australia. There's obviously a very strong fiscal position here as well, and the Perth or WA household looks to be reacting quite strongly.
Okay, you have got one. Superannuation funds have been affected negatively by the announcement of tariffs. Do you foresee further decline in the super funds performance?
So I can't really comment necessarily directly on how the fund's performances are, but I will just say, as I kind of mentioned a little bit earlier, there has been a recalibration of the idea of US exceptionalism, and that's seen in particular US equities really being hit quite hard. That obviously has implications for people's superannuation portfolios. And obviously the Aussie share market has been affected as well, but hasn't all just been sort of bad news. We are seeing now a sort of a pivot around a story that, in Europe actually, there's now going to be green shoots there. They've just been announced in Germany, a big fiscal package focused around defence spending, and that has spurred a strong rally in European equities. So I think it's not really all just about the US and downside risk there. There are certainly the case to be made that other parts of the world could see some boost, say in Europe, where there's going to be probably a stronger focus now on I guess, trade around the European Union, and also around, stronger fiscal impulses to offset the impact from these US tariffs. So I think the short answer is it can vary depending on the different economy that you're looking at, and there are, in some cases, winners and losers to what happens here.
Fantastic. That was a great question too. Well, Stephen, thank you so much. I'm going to give you this gift and mention that we are making a donation to WA Food Bank on your behalf as well, and the CBA. So, ladies and gentlemen, round of applause again for Stephen Wu, Commonwealth Bank. Thank you.
Thank you, everyone.